Bismillahirrahmanirrahim. In the previous class, if you people remind, we were talking about company types, that is investment companies types. In that we discussed about unit investment trusts, then we discussed about exchange traded funds, shortly ETF. Then we discussed about closed-end investment companies. We discussed about closed-end investment companies, that those investment companies which cannot issue additional shares after IPO, initial public offering. Now, these closed-end investment companies, there are currently about 650 closed-end funds trading on the market, yet they are not well known by retail investors. There are 650 closed-end funds that are trading on the market, but they are not well known by retail investors. Some funds like BlackRock Corporate High Yield Fund 6, HYT High Yield Fund Trading Fund, pay a dividend of more than 8%, making these funds an attractive choice for income investors. Income investors are those investors who are waiting for dividends. They are not looking for capital gains. They are looking for the dividend that is paid by this fund. Some investors, what are they doing? They are buying shares. When the prices are going up, they are going to sell it. And these income investors, what are they doing? When they are purchasing shares, they are holding it for a long period of time, and when dividend is announced, they are waiting for that dividend, they say. So this BlackRock Corporation High Yield Fund, it pays 8% dividend to their investors. But investors have to know one key fact about closed-end funds. That is an important point. Nearly 70% of all these products use leverage as a way to produce more gains. You know about leverage, the use of debt financing. They are taking too much debts. Using borrowed money to invest may produce big returns, but it could also put the fund under intense pressure. The problem in these closed-end funds is that they can't issue additional shares. So their capitalization, it is fixed. When the capitalization is fixed, when they need money, so they can't issue additional shares. So what are they doing then? They are taking loans, they are using leverage, they are using debt financing. And if there is possibility that debt will produce a high return, but there is also possibility that the company will go into a loss, and when it goes into a loss, then there will be a huge pressure on this company. Then there is a the next type of investment company, and that is called open-end investment company. So now see this open-end investment company. Share continue to be sold to the public at net asset value after initial sale. and its total capitalization changes over additional issuance. Now look at this point. In the previous class, I told you that if it is a closed-end investment company, so when they issue shares initially, that is IPO, initial public offering, they can't issue shares to the public again. Suppose this is public. So once shares are issued in IPO, suppose they issued 100,000 shares. So now they can't issue additional shares. Suppose the price of one share, it is $100. So 100 multiplied by this, so it becomes 1, 2, 3, 4, 5, 6 and 7. So see, 10 million. So they received $10 million. This is their capitalization. This is their basically capital. Since they cannot issue additional shares, so this capitalization, it is fixed. Their capitalization is what? Is fixed. Why? Because they can't issue additional shares. But open-end investment companies, open-end investment companies, once they issue shares to the public in IPO, this is public. Suppose once they issued 100,000 shares. The price of one share is $100. Now if public is demanding, they can issue additional shares. Suppose they will look at the demand of the public, fund's performance is good, so people's demand will increase. So what will they do? They will issue additional shares. They issued additional 50,000 shares to the public. So first their capitalization was 10 million, now it becomes 15 million. That is because they issued additional shares. So they will receive additional money. So previously their capitalization was 1 lakh multiplied by 100. So it will be 10 million. But now they are issuing additional shares, 50,000. So 50,000 multiplied by 100. So they will receive 5 million additional money. So their capitalization from 10 million, it moves to 15 million. So their capitalization is what? Their capitalization, its total capitalization changes over additional issuance. When they issue additional shares, so their capitalization will change. Open-end investment companies are issuing as many shares as investors are willing to buy. If people, their demand is increasing, so they will issue these additional shares. The company, they also buy shares back from the investors. In closed-end investment companies, if you people remind, we discussed that they can't buy the shares back, but open-end investment companies, they are also buying back shares from the investors. If investors want to sell it, they can't sell it in the open market. They will give it back to the company. It's provide liquid. It provides liquidity to investors. Liquidity means anytime they can convert their shares to cash. Shares may be sold back to the company at net asset value. We discussed about net asset value in the previous class. I'm not going to discuss it again. Company size constantly changes. I told you that total capitalization is changing. When total capitalization changes, company size it will change with the capitalization. That is previously 100,000 shares, now 50,000 additional. So the company size will increase. But if the public returns these shares back to the company, so again the capitalization will change. It will be contracted. It is popularly called mutual funds. These open-end investment companies, it is also called mutual funds. Before investing in an open-end funds, it is better to check the prospectus of the securities, that is the fees, the historical performance, etc. Keep in mind whenever you are investing in open-end funds, you will look at the fees. In investment companies, they are charging fees. So you will look at the fees, and you will also check the historical performance of this fund. If the historical performance of the fund is good, you will invest in this fund. If the historical performance is not good, so then you will not invest in this fund. Now here are some other points in open-end funds. Shares of open-end funds are bought and sold directly from the fund at a price per share that is based on the value of the fund's underlying securities. See, shares of open-end funds are bought and sold directly from the fund. You will directly buy it, you will directly sell your funds at a price per share that is based on the value of the fund's underlying securities. Whatever is the value of a security, you will sell it on that value. On each trading day, typically at the end of the day, the net asset value is calculated. The fund will calculate the net asset value by dividing the market value of the fund's assets less expenses by the number of shares held by the investors. We discussed about the calculation of net asset value in the previous class. So on the close of the end, at the end of the day, the fund will calculate the net asset value, and they will purchase these shares from you on that net asset value. If you will buy, if you want to sell, so that net asset value, on that net asset value, they will buy and they will sell. The fund will buy and sell these shares from you. Open-end products may represent a safer choice than closed-end funds. As compared to closed-end funds, open-end funds are safe, but the closed-end products might produce a better return. But closed-end funds, mostly they are producing good returns as compared to open-end fund. So risky investors, they are selecting closed-end funds, and those who do not want to take much more risk, so for them open-end fund is better, combining both dividend payments and capital appreciation, because in closed-end funds there is capital gain as well as dividend payments both. Of course, investors should always compare individual products within an asset class whenever you're going to invest, so you will make a proper analysis. You will make a comparison of individual products. Some open-end funds may be more risky than some closed-end funds, but there are some open-end funds which are much more risky than closed-end funds. Some, I'm not talking about all. Mostly open-end funds are less risky, but some open-end products, these are more risky than closed-end funds. Then these open-end funds, that we call it mutual funds, these are further classified into different categories. One is money market mutual funds. These are mutual funds that invest in money market instruments. Keep in mind, in the previous classes we discussed about that. What are they doing, these open-end funds? They are issuing shares to the public. The money that they are receiving, they are investing it in bonds and shares. So, when they received money from the public, they are further investing it. So, these money market funds, money market mutual funds, or money market open-end securities, they are investing in money market instruments. Money market means those securities whose maturity is less than 1 year. So what will they do? What are they doing? They are mostly investing in commercial paper and T-bills. It is divided into taxable money market funds and tax-exempt money market funds. There are some funds which are taxable. There are some money market securities which are taxable, but there are some money market securities which are tax exempt. Taxable money market funds is that mutual fund which keeps a portfolio in money market security which have average maturity of 90 days. These are those money market securities whose maturity is 90 days. Government charges taxes on these securities, and government is charging taxes on that. That is, from the profit, government will deduct taxes, and the remaining money they will give it to you. The next one is tax-exempt money market funds. Is that mutual funds which invest in short-term municipal securities and must have an average maturity of 90 days or less. Keep in mind, municipal, the word municipal, it is used for the provincial government. So, those securities, basically in USA, there are states. Each state, they have their own law. So, these states have their own laws. So, sometimes if that state required money, so they are issuing money market securities, that is T-bills. Those T-bills whose maturity is 90 days or less, and they are giving an option to the investors that we will not charge the taxes on these securities, giving benefit to the investors, that if you will invest in these municipal securities, our municipal T-bills, so we will not charge any taxes from you. So these are taxable money market funds, and these are tax-exempt money market funds. So taxable money market funds, on which if there is profit, So from profit they will deduct tax and then they will return the remaining profit to you. And tax exempt money market funds are those on which the government is not charging any taxes. They will give you the whole amount. Suppose you invested $100,000 in money market securities. On that, you generate $10,000 profit. From that $10,000 profit, suppose there is 8% tax. So government will deduct 8% from you and will give you the remaining money. That is called taxable money market funds. And in tax exempt, if your profit is 10,000, government gives you what? Tax exemption. So they will not deduct the taxes from you. These are called tax exempt. They will give you this 10,000 profit, the whole 10,000 profit. I think for today it is enough. Inshallah, in the next class then we will discuss about some other open-end funds types or mutual funds types.